Hello, this is Sam Ghosh, and welcome to the review of Indian Union Budget 2020-2021. I have taken a very comprehensive view of the budget as a tool to cater to two purposes. First, to cater to the long-term policy objectives for the country, and the second, to cater to the current macroeconomic situation. To do that, I have divided this presentation in 6 parts. The first part, the policy imperatives, deals with the long-term policy objectives for the country and comes from the economic survey. The second part, macroeconomic review, deals with the current macroeconomic situation around the globe and in India. The third, the financial system, deals with the different changes this budget is proposing to introduce to the banking system and to the financial markets. The fiscal strategy comes from the mid-term fiscal strategy and deals with the high level of fiscal strategy. And sources of funds and use of funds. The sources of funds deals with the disinvestment and the taxes. Use of funds deals with the allocations. So let's get started. As mentioned before, this part, the policy imperatives, deals with the very long-term policy goals for the country, and it comes from the economic survey. It deals with the different studies carried out. So one of the studies is on entrepreneurship, and it found that the entrepreneurship intensity in India is very low. It is 0.1 firms registered per 1,000 workers compared to 12 in US and UK. It also found that the registration firms increases with higher literacy, higher number of colleges, better access to markets, and flexible labor regulations. Now, another part is creating a level playing field for new businesses. So this is pro-business and pro-crony policies. So pro-business policies is when everybody has a level playing field, efficient allocation of resources, and political connection doesn't create market power. It shows that after the 1991 economic liberalization, there has been a boon. It has been a boon for Indian economy because it has introduced different competitive markets. It shows that politically connected firms, outperform the market in the short term but destroy wealth in the long term. Now, the firms who get political support underperform their peers in financial terms, profitability, return on equity, etc. The another part for entrepreneurship, another important issue for entrepreneurship is ease of doing business. India improved ranks. It's ranked by 79 positions. But there are still some problem areas like starting a business, registering property tax, paying taxes, enforcing contracts, etc. Another major issue is the export logistics. Exports will be a major area for India going forward, and we'll discuss about that later. So this is a problem area. Export logistics has to be improved. Now let's talk about the economic freedom. Now, this study found that government intervention in free market actually decreases the efficiency of market, and they are actually very counterproductive. And they create generally the opposite results than the intentions. So some of the interventions in form of the Essential Commodities Act of 1955, drug price controls under ACA, then government intervention in the grain market, debt waivers, etc. All these things actually are counterproductive. So it is better to understand for policymakers what markets can and cannot do. So what markets can do, the policymakers should not worry about them and should focus on what markets cannot do. So the markets can do are to keep prices in check, use resources efficiently, encourage efficiency, etc. What markets cannot do, to provide public goods, prevent abuse of monopoly power, etc. Now let's talk about exports, and I'm very glad that the demand side of the economy is getting some attention. The future growth of Indian economy needs to come from exports. Now, 50 to 60% of the GDP comes from private consumption. India has a negative net export. For going forward, for job creation, boosting the export sector is very, very important. The current international trade environment gives India the opportunity because of the shifts in the global value chains. Now, India can grab the labor-intensive export market. It can create jobs, a lot of jobs and consumption. It can boost the consumption and create a virtuous cycle of more jobs and more consumption. The study finds that India can create around 40 million well-paid jobs by 2025 and 80 million jobs by 2030. It can grab 3.5% of the global export market by 2025 and 6% by 2030. The kind of products India should focus on are network products, according to the study. These products are produced across the global value chains and operated by multinational corporations. This will be a $7 trillion market by 2025. China historically outperformed India, but because of the changes and the trade situation, trade environment, India can grab this opportunity. Now let's talk about the banking and NBFCs. This has been 50 years from the bank nationalization, 2019 actually. But Indian banking system is disproportionately underdeveloped. India has only one bank in Global 100, where it should have at least 6. The public sector banks account for 70% market share, whereas they are the most inefficient and riddled with NPAs. Some figures here makes it very clear. You can see the bank frauds, 90% of them happens in the public sector banks. The gross NPA are higher in the public sector banks. Return on equity is lower, is abysmal for public sector banks. The economic survey, recommends that the public sector banks need to attract better quality talent and they can introduce incentives like ESOP. Start using technology like big data and machine learning to finding default patterns. So the study recommends creating a GSTN-like entity to gather PSB data and carry on analysis in a centralized manner. Another factor is the strengthening the legal framework so that the banks have a legal channel to deal with the defaulters. Now, NBFC sector went through a serious liquidity crunch. NBFCs borrow shorter duration to lend long duration. Now, this introduces them to the rollover risk. And sources of the rollover risk are the asset liability management risk, interconnectedness, etc. Now, the NBFC sector has been largely dependent on the liquid debt mutual funds for short-term funding. These are the funds which invest in very short-term debt securities. This created a very interconnection between NBFC sector and liquid mutual fund sector. Now, because of this is a contagion, and so crisis in one sector can spread to another sector and vice versa. This is a concern. Now we will talk about the macroeconomic scenario globally and in India. Now let's talk about the macroeconomic scenario. 2019 has been a bad year for both the global economy as well as the Indian economy. The global economic growth was 2.9%. It was the slowest from the global financial crisis. Now, the protectionist policies of China and USA and the rising US-Iran tension can create further problems. you can see here um, that all all every economy actually all the economies actually kind of underperformed compared to their long-term average. Now let's come to India. The current Indian GDP, that is 2019 GDP, was 2.9 trillion. The real growth in the first half of the financial year 2019-20 was 4.8%, and the estimate for the whole financial year 1920 2019-2020 is 5%. Now, the cause of this slowdown um, was the real consumption slowdown in the first half of the year, and which resulted in the slowdown in real fixed investment growth. The, the recovery in consumption in the second half, backed by higher government consumption, actually increased the GDP a little bit. For the 2020-2021 estimate is 5.8%. Now, if you look at the prices. The headline inflation increased from 3.3% in the first half of the 2019-20 fiscal year to 7.4% in December. Is fundamentally based on the food prices. It's just because of the higher food prices. Now let's go to the bank credit. We can see that it's a downward trend, and especially the service sector, the credit to the service sector was really bad. It decreased quite a lot. Now the current account deficit, it improved to 1.5% of GDP from 2.1% in 2018-19 in the first half of 2019-20 fiscal year. But this is not a good news really, because the imports contracted faster than the exports. Both contracted, imports and exports both contracted, but imports contracted more sharply. It actually shows a lower consumption in the local market rather than improve competitiveness. Now, the monetary policy, so RBI and Monetary Policy Committee, they reacted with the 110 basis point repo rate cut in 2019-20, and there has been 4 open market operations and 1 buy-sell swap auction. Now, in the fiscal policy front, the deficit target was 3.3% for the year. It has been increased to 3.8%. The major fiscal policy action was the corporate tax rate cut for new manufacturing companies to 15% from 22%, and for existing companies to 22% from 30%. Now let's talk about the financial system, how this budget proposes to bring changes to the financial banking system as well as the financial markets. Now let's talk about how this budget proposes to interact with the financial markets and the banking system. For the banking and NBFCs, the deposit insurance coverage will be increased from 1 lakh to 5 lakhs. This is a welcome step. And there has been a proposal for amendment to the banking regulations to strengthen the cooperative banks with view of the current corporate problems with the cooperative banks. And now the NBFCs of asset size up to 100 crores, which was 500 crores previously, and loan size of 50 lakhs, previously 1 crore, now will be eligible for debt recovery under the SARFAESI Act, which is the Securitization and Asset Restructuring Act. There is a proposal for a scheme to provide subordinate debt for entrepreneurs of medium and small businesses, and there's been a proposal for handholding support for companies in selected industries to make them more competitive in the export markets. Now, for the financial markets, certain categories of government securities would be opened fully for non-resident investors. Now, this is a welcome step. Limit for the FPIs in corporate bonds, currently at 9% of outstanding stock, will be increased to 15%. So the foreign portfolio investors, can own up to 15% of outstanding stock of a company. Now, the legislation for netting of financial contracts to be introduced, and a new debt ETF consisting primarily of government securities will be introduced. So now let's talk about the broad fiscal strategy. So let's talk about the high level fiscal strategy. This has been a difficult year fiscally for Indian economy. The fiscal deficit was revised from 3.3% to 3.8% given lower tax collection and also the corporate tax rate cuts. Going forward, these are the budget estimates for 2020-2021. So the fiscal deficit target is 3.5% and the revenue deficit 2.7, primary deficit 0.4, and all these things, and you can central government debt as 50.1%. The fiscal deficit is the difference between the revenue receipts plus the non-debt capital receipts and minus the total expenditure. It reflects the total borrowing requirement of the government. So this is what we need to understand. Going forward, 2021, 2022, we are seeing that the fiscal deficit target has been getting lowered, so it is like 3.3% and 3.1% going forward. We can see that this is the trend. So the fiscal deficit has been decreasing over the year, and apart from this current financial situation, we can expect this to happen going forward. This is a very good schema to have. We can see that the total budget size is 30.42 lakh crore rupees. 1 lakh crore rupees comes around 14 billion USD. So it comes around 415 to 430 billion USD budget, and it gives a very good picture of the comparative size of different allocations, different sources of funds and different allocations. And then now we will talk about the sources of funds. Now let's talk about the sources of funds. The major sources are corporate tax, income tax, customs duty, etc. The corporate tax is budgeted at 18%, income tax 17%, customs 4%, union excise duty 7%, GST 18%, non-tax revenue 10%, non-debt capital receipt at 6%. The rest 20% from borrowing on other liabilities. Disinvestment, the major part is through LIC, the partial sale of LIC stake through IPO, and also the rest stake of IDBI will be sold to private, retail and institutional investors. Now let's talk about the direct taxes. A new tax slab, optional tax slab, is introduced for individual taxpayers. But this is applicable in case they forego some of the deductions and exemptions. The additional deductions of 1.5 lakhs on interest paid on loans taken for the purchase of affordable housing will be extended to 31st March 2021. This is a new one. The upper limit placed on the tax-exempt employers' contribution to Provident Fund, Superannuation Fund and NPS contributions. The upper limit is 7.5 lakhs. For non-residents, the time period till which they will be considered as non-residents is reduced to 120 days. It was 182 days before if they are Indian citizens and person of Indian origin. Now, another major change is the dividend distribution tax. So this is abolished now. The companies currently pay 15% DDT on the dividend paid to the shareholders. Now these are many problems, like foreign investors cannot take tax credit and all these things. So now companies will not have to pay the dividend distribution tax, and the dividend will be taxed as ordinary income in the hands of the investors. The holding companies are allowed to deduct. Another part is in the corporate tax part. The concessional rate of 15% was introduced for newly incorporated domestic companies engaged in manufacturing. Now this concessional rate will be extended to the electricity companies, the power companies, and the power companies who are engaged in generation of electricity. So this is the base rate. Now TDS for technical services used to be 10%, and now it will be reduced to 2%. For e-commerce sector, currently there is a TDS on book of 1% in case of PAN and Aadhaar. So if the sellers provide their PAN and Aadhaar, then TDS is 1%. If they don't, then it is 5%. They will be now the people who are making less than 5 lakh will be exempted from them. In case of individuals and HUF, exempted from the TDS. In case of startups, the ESOPs are taxable. So the startups use ESOPs to attract and retain high quality talent. It used to be taxable, and it is now taxable as perquisite at the time of exercise. Now it will be deferred by 5 years or till the employee leaves the company or when they sell the shares, whichever is earliest. Eligible startups are allowed to deduct 100% profits for 3 consecutive years out of 7 if the total turnover doesn't exceed 25 crores. The turnover limit will be extended to 100 crores. The eligibility period will be extended to 10 years. For foreign investors, sovereign wealth funds of foreign governments are exempted 100% to their interest, dividend, and capital gains income in respect of investments made in infrastructure and notified sectors before 31st March 2024 with a minimum lock-in of 3 years. There is an extension of the period of concessional withholding tax of 5% under Section 194 LC of interest for interest payments to non-residents in respect of money borrowed and bonds issued. This will be extended to 30th June 2023. The extension of the lower rate of withholding of 5% under Section 194 LD for interest payments to FPIs and qualified foreign investors in respect to bonds issued will be extended to 30th June 2023. The withholding rate will be reduced from 5% to 4% on interest payment on the bonds listed on the International Financial Service Center or IFSC exchange. For cooperatives, they are currently taxed at 30% with surcharge and cess. There is an optional slab of 22% plus surcharge, 10% surcharge, and 4% cess with no exemptions and deductions. Also, will be exempted for alternative minimum tax. TDS on interest paid by large cooperatives. So there is an introduction of TDS on the interest paid by large cooperatives who are exceeding gross receipt of 50 crores or more. For MSME sector, MSME companies, the audit requirement is reduced. Audit requirement was if their turnover is more than 1 crore. Now it will be increased to 5 crores. The companies more than 1 crore but less than 5 crore turnover will not have to get audited. Now, this is applicable only in case the MSME carries out less than 5% of their business in cash. So this is a boost to the digital economy. For real estate sector, currently while taxing income from capital gains, business profits, and other sources in in respect to transactions in real estate, if the consideration value is less than circle rate by more than 5%, the difference is counted as income both in hands of the purchaser and the seller. The limit is now increased to 10%. Now there are some procedural improvements. So there is a new scheme of Vivad Se Vishwas. This is a direct tax dispute resolution scheme. A taxpayer would only be required to pay the disputed taxes and the amount of disputed taxes and will get a waiver on interest and penalty if they pay by 31st March 2020, and some additional amount if they pay by 30th June 2020, but after 31st March. The process for filing exemptions on donations to charitable institutions, there will be some pre-filled donor information. Registration of charitable institutions will be now electronic registration. They will be provided a unique registration number. There will be introduction of faceless appeal in case of income tax dispute, and Central Board of Direct Taxes will be adopting a taxpayers charter, and online PAN allotment using Aadhaar is also introduced. Now let's talk about the indirect taxes. So the mainly indirect taxes in this budget focuses on the customs front. So there is amendments to Customs Act and other related acts. So there is introduction of a new section of 28DA. So this enables the government to administer a preferential tariff treatment regime under the trade agreements, and there is introduction of new obligations on importers and some time-bound verification, some explanation, etc. Now, the clause F of section 11(2) of Customs Act, it empowers the central government to prohibit import and export of gold and silver to protection of the economy. Now this is extended to any other goods. A new section of 51B, which provides for the creation of electronic duty credit ledger in the customs system. The Customs Tariff Act will be amended. Section 8B will be amended to make provisions for the application of safeguard measures such as tariff rate quota and any other safeguard measures to protect domestic industries. And the first schedule will be amended to introduce some tariffs on wall fans and etc. In the countervailing duty rules and anti-dumping duty rules will be amended to strengthening the anti-circumventing measures as per international best practices, and the new provisions to enable investigation into a case of circumvention of countervailing duties. Now there has been some changes, introduction of some changes in the customs duties. A major part is a new cess, 5% health cess on the medical equipments. Some other withdrawals and increases and reductions are also proposed. Now we will talk about the use of funds. Now let's talk about use of funds. So the centrally sponsored schemes will take 9%, the central sector schemes 13%, interest payments 18%, defense 8%, subsidies 6%, finance commission and other transfers 10%, state share of taxes and duties 20%, pension 6%, and other expenses 10%. Now let's talk about allocation to different sectors. For the infrastructure sector, the government introduced National Infrastructure Pipeline or NIP last year, which will invest $1.4 trillion or 103 lakh crore in 5 years. This will involve 6,500 projects on housing, safe drinking water, access to clean and affordable energy, etc. The project preparation facility for infrastructure projects actively involve young engineers, management graduates, and economists. Now, national logistic policy will be released soon. Uh, the focus will also be on accelerated development of highways and monetization of at least 12 lots of highway bundle of over 6,000 kilometers before 2024. For the transportation sector, Indian Railways will focus on large solar power capacity alongside rail tracks and some railway station redevelopment projects. For water and ports and waterways, the corporatization of at least one major port or stock exchange listing will happen. Air traffic, 100 more airports by 2024, and air fleet number to grow from 600 to 1200. The total allocation will be around $23.8 billion or 1.7 lakh crore. For in the energy sector, the expansion of the national gas grid from 16,200 kilometers to 27,000 kilometers, and the total allocation for power and renewable energy sector is $3 billion, around $3 million, or 22,000 crores. In case of technology, a new policy will be introduced which will allow the private sector to build data centers. Fiber to home connections or FTTH through BharatNet will link 100,000 gram panchayats this year, and this will involve $0.84 billion in BharatNet. Now, a digital platform for intellectual property rights will be introduced, and new endeavor, two national level schemes will be introduced to map the genetic landscape of India. Also, the government talked about early stage funding of startups, and a national mission on quantum technology and applications will be introduced. For industry, investment clearance cell for startups will be introduced, and some schemes focused on encouraging the manufacturing of mobile phones, electronic equipment, and semiconductor packaging will be introduced. Now, this is linked to the network products for the export market we talked about before. A national textile mission will be introduced, and the turnover of the government e-marketplace will be increased to rupees 3 lakh crore or 42 billion. For agriculture and rural development, measures for 100 water statistics will be taken. This is a major issue. The water stress will be a major issue in the coming years. And also the solar pumps under the PM Kusum scheme will cover more 20 lakh farmers or 2 million farmers. A national corn supply chain will be in focus using the Kisan Rail and Krishi with the Udan, basically railways and airlines. And the target for the agricultural credit market, agricultural credit will be increased to 15 lakh crore or 210 billion. The fish production will also be encouraged. Increasing the fish production will also be encouraged. In the health sector, new hospitals through the PPP mode will be encouraged, and the viability gap funding window will be created for that. The expansion of the Jana Aushadhi Kendra scheme to all districts are offering 2,000 medicines and 300 surgeries by 2024. Swachh Bharat mission gets around $1.7 billion or 12,300 crores. The piped water supply to all houses, this will get $1.6 billion allocation, around $1.6 billion. For in the education sector, a new education policy to be introduced soon. Also, FDI and external commercial borrowing will be encouraged in this sector. And 150 higher education institutes will start taking apprentices, and in the degree and diploma courses. Um, Urban local bodies to provide internship opportunities to fresh engineers for a period of 1 year. A new scheme of study in India, under which INSAT in Asian and African countries will be introduced. A new National Police University and National Forensic Science University will also be introduced. And some medical colleges, new medical colleges with existing district hospitals in PPP mode will be encouraged. Now, in welfare, for welfare, around $5 billion for the nutrition related programs, around $4 billion to programs specific to women, around $11.9 million for the welfare of scheduled caste and other backward classes, around $7.5 billion for the welfare of scheduled tribes, and around $1.3 billion for the senior citizen welfare. With this is Sam Ghosh. Thank you very much for watching. Bye bye.